Hi there, Dan Kerr's DK Analytics. It is Thursday, April 9th, 2020. Thanks for tuning in. Topic of this video is Stagflation Revisited. We go over some valuation metrics. US dollar index stood at 99.43. The Fed's balance sheet expanded further to 6.1 trillion, a new record. The US 10-year yielded 0.72%. The S&P 500 continued to gain altitude, stood at 27.90 at this afternoon's close. Oil at $23.19 per blue barrel. Gold at 1,741 per troy ounce, and silver at $15.92 per troy ounce. With massive monetary and fiscal crony pork being rolled out, precious metals prices have been rising. The Fed's balance sheet is set to expand another $2.3 trillion on top of the current record-breaking $6.1 trillion, which will amount to a $4.5 trillion expansion of its balance sheet from $3.9 trillion a year ago, which would constitute a rise of 115%. And we may well see more, perhaps much more. As already mentioned, the Fed is expanding its purchases to junk bonds, collateralized obligations, and to spendthrift states in dire fiscal straits. I'm a bad poet, I know it. No, but with all seriousness, this is doubling down on moral hazard. The reckless get bailed out, and the prudent pay the price. Meanwhile, Main Street remains largely shut down and told to stay home to avoid massive coronavirus deaths or infections, even as evidence increasingly suggests that the overall death rates from this virus won't differ substantially from other viruses. That is, from 0.1% to 0.6% of those infected, as tests of an increasingly wide segment of the population attest. Note that the Center for Disease Control's, the CDS's, coronavirus death estimate has plummeted from 2 million to 220,000 to between 150,000 to 200,000 to 60,000 yesterday, and would likely be lower if pre-existing conditions were reflected. The authorities will claim social distancing and lockdown successes. I would point to intuitive societal remediation reactions. If you got a flu, you stay home, or you get sent home, and weaker, older members of society avoid unnecessary visits with others. I would point to intuitive societal remediation reactions and to Mother Nature's antibodies virus wet blanket response amongst the broad population as the primary reasons for a constructive trajectory here, much lower projected deaths. And frankly, that the virus wet blanket response, courtesy of nature's antibodies successfully putting the virus down, will be the likely upside aspect of a rapidly spreading virus. In fact, let's examine some state-based evidence trickling in that I had courtesy of a 4/9/20, today, April 9th, episode of Ron Paul's Liberty Report. I have that courtesy of watching his report. Specifically, states with little or no lockdown or social distancing proclamations should, if Dr. Fauci of the CDC was right, have higher coronavirus death rates, right? Let's compare Colorado with extremely strict lockdown / stay-at-home proclamations with similar population South Carolina, which didn't suffocate civil liberties. In Colorado, 193 coronavirus-induced deaths have been reported as of yesterday, April 8, 2020. In South Carolina, meanwhile, 63 deaths were reported as of yesterday, roughly a third. Let's look at other states that remained open and cite their coronavirus-related death totals through yesterday. Arkansas, 18. North Dakota, 4. South Dakota, 6. Wyoming, 0. Yet, people have become very fearful as the virus demagoguery has been 24/7 relentless, courtesy of our Pravda press, eager to work together with overzealous statist bureaucrats and elected officials at the local, state, and national levels. Officials that are eager to expand their power in the process of eviscerating Bill of Rights protections or civil liberties, from the right to peacefully assemble, to privacy protections, to property right protections. As far as the right to peacefully assemble, I'm going to provide you a link in the video notes section for flavor out of Colorado. It'll make you think twice. If your small business is forcibly shut down for any sustained period of time, your property and years of labor, sometimes decades of labor, how you have spent so very much of your time to generate sales, to feed your family, to hire people, and to contribute to society will effectively have been taken from you, in the process often killing your business and possibly your life savings. The takings clause of the Fifth Amendment is supposed to prevent this. Talk about legitimate reasons to consider suing your local or state government. I will also provide a link to that takings clause. To add insult to injury, so many people are now so petrified about the lurking silent killer that on top of a supply collapse, we're looking at a better not venture out necessarily demand collapse, which rising fear over a frightening rise in unemployment will only heighten. An additional 6.6 million Americans filed for unemployment benefits during the past week, for a devastating total of 16.6 million Americans out of work in the last 3 weeks, which constitutes a whopping 10.4% of the previously employed ranks in the United States. Now, with both supply and possibly demand facing an absolutely over-the-top virus response-induced body blow, the Fed is busily expanding its balance sheet well in excess of 100%. Does anyone remember the true definition of inflation? Webster's dictionary used to offer it. In the vernacular, it's too many dollars chasing too few goods and services. Let's assume that people come out of hiding. Let's say demand comes back. And let's say it actually happens sooner than later and people get back. People have short memories, right? But let's say they get permission to leave their houses and again regain trust, and then transactions become more possible and the 6 feet distancing jazz starts to evaporate. And anyway, hiding under your bed gets old pretty fast. In such a world, consumers or buyers will face substantially reduced supplies of goods and services, which obviously, all things being equal, will imply higher prices. And they will tend to take a fatter page out of the prepper's home supplies book just in case lockdowns reoccur if this virus reaccelerates. Or another such situation is in the office. And as said, companies will attempt to move from just-in-time inventory practices in an unreliable global supply chain world to having spare inventory when it counts. Screw asset turns and return on investment improvement, for if companies can't get their components, they can't sell their wares. And if groceries can't get their fruits, vegetables, eggs, and toilet paper, they won't have much of a top line either, much less constructive asset turns. Together, this should lead to a trend reversal to the upside in both home and corporate inventory levels, which will fuel higher demand juxtaposed against supply side constraints. From perishable items such as farmers' harvests, which are now tragically rotting in the field here in Southwest Florida, or a part of them did because restaurants closed down, to shortages of globally sourced components from pharmaceuticals to off-road vehicle drivetrains. Now, sprinkle a ton of money creation, both in the US and globally, on top of supply constraints and a likely sea change in private sector inventory holdings, and you've set up a perfect monetary inflation storm, which rising prices and sustained rapid money creation, vastly outstripping economic growth, will only reinforce. In short, instead of corporate treasurers buying back stock or consumers waiting for cheaper prices for essential goods and services, the money the Fed and other central banks create will increasingly find its way into the real economy instead of into stocks and bonds. This will push the money multiplier higher. Higher still, it had already been arcing up until year's end when the Fed decided to stop releasing it here in the US. Well, a higher money multiplier is going to be the transmission mechanism of our unparalleled central bank monetary base continuously expanding into the money supply. In other words, we're going to have a very marked rise in the money supply, which has already happened, and I think we've just gotten started as a result of this. In the process, this will also stoke PPI and CPI-based inflation readings. Many financial commentators and observers will say that rising inflation cannot coexist with a depressionary economy, yet they forget about the printing presses, which is what is going on, a depressionary, hyperinflationary situation in Venezuela, Argentina, Zimbabwe, Iran, and elsewhere. Those same people also tend to forget how to spell stagflation, that is, the 70s and the early 80s. And they conveniently forgot about bond vigilantes and how they reacted, which manifested in US 10 and 30-year Treasury yields topping out at well over 15% in 1981. Plus, numerous commentators, including ones I otherwise respect highly, are convinced that the Fed's rampant money printing won't lead to higher interest rates for three reasons. First, every other central bank is buying bonds with printed money. Second, because there are no positive yields anywhere in terms of OECD nation debt. And third, that massively rising deficits will be financed swimmingly by record central bank balance sheet expansions. I disagree. In fact, I disagree strongly. First, the US is the world's greatest debtor ever, by far, and America requires the most overseas financing. It is thus a hugely cash flow negative nation whose cost of money will rise disproportionately to free cash flow creditor nations when push comes to shove. Second, foreign investors have held US paper believing that the Fed could shrink its balance sheet, the opposite of massively debasing the value of their holdings held in a foreign currency. Those parties, once the Fed stuffs the world with enough dollars to overcome the dollar liquidity crisis, and it will be successful, those parties, those overseas creditors, will gladly sell their treasuries to the Fed, which will only bloat the Fed's balance sheet even further. Third, sustained massive Fed balance sheet expansion amidst lingering supply constraints and higher desired corporate and household inventory levels, my forecast, my conviction, will only serve to strengthen and heighten inflationary expectations in the US as dollars come home. Foreigners sell them to the Fed. You don't reduce rising inflationary expectations and the demand for greater risk premiums, higher yields, by printing increasing amounts of money relative to underlying growth, by monetizing ever more recklessly, monetizing ever more debt recklessly. What's the upshot? It looks like we're racing towards a stagflationary world at record speed, despite the demand body blow. Please reflect on how bonds and stocks were valued in such a world, namely in the 70s, when we had double-digit bond yields and single-digit PEs. Afterwards, check your portfolio yields, your portfolio bond yields, and your portfolio PEs. And don't forget that the E in the PE, in the price earnings ratio, is set to plunge. For those that bought bonds and stocks at elevated valuations / prices, you may want to reduce value at risk or capital at risk and avoid being trapped in low bond yields and low dividend yields on your stocks while your assets crater in value. Said differently, take the opportunity to avoid double jeopardy. Those are my thoughts for today. Over and out on April 9th, 2019. I thank you for listening. Bye-bye.